When buying, selling, or refinancing a home, closing costs are the fees associated with the closing of the transaction. Many lenders advertise or market a no closing cost mortgage. But don't be fooled. There is no such thing as a no closing cost mortgage. The costs to originate a mortgage are present for every loan. Fees vary from state to state, but typical fees a borrower may encounter when closing a mortgage include origination, processing, underwriting, credit report, flood certifications, appraisal, attorney fees, pest inspections, title insurance, title search, closing protection letters and other title-related charges, deed recordings, survey, closing, and other mortgage-related taxes or fees. When a lender talks about a no closing cost mortgage, what they are doing is quoting an above-market interest rate that contains enough additional income, allowing them to issue a credit sufficient to cover your closing costs. This can be a good strategy in some circumstances, but a poor strategy in others. Because the actual cost to originate a mortgage don't vary based on loan size, let's take a look at an example. Borrower A is financing $75,000 on a new mortgage, and the total closing costs are $2,500. Borrower B is financing $250,000 on a new mortgage, and the closing costs total $2,500. And borrower C is financing $400,000 on a new mortgage, with total closing costs totaling $2,500. When you lock an interest rate, your lender guarantees the interest rate, assuming the loan closes and funds prior to the expiration of the lock. Even if interest rates have risen since locking, the locked rate won't change. Assume today's current market interest rate for a 30-year fixed rate mortgage is 4.5%. Any interest rate above 4.5% is considered above market, and the lender would receive additional premium or income which is credited to the borrower to pay the closing costs. Let's assume that an interest rate of 4.625% paid an additional 0.625% premium to the lender, and an interest rate of 4.75% paid an additional 1% premium to the lender. The premium is always based on the loan amount, so in our example, the chart shows what the additional premium would be. This example illustrates that to pay $2,500 in closing costs for borrower A, the lender would need to increase the interest rate significantly above 4.75%, since only $750 of the closing costs are covered with the additional premium. Borrower B, however, could cover the entire $2,500 in closing costs at an interest rate of 4.75%, and borrower C could cover their closing costs at an interest rate of 4.625%. To determine if a no closing cost mortgage makes financial sense, take the amount of the lender credit and divide it by the difference in monthly payment. This will tell you how many months you must live in the home to have a dollar advantage between paying closing costs or financing them. Since our lender credit was $2,500 in the example, this is how to determine if a no closing cost mortgage at a higher interest rate is less expensive than paying closing costs at a lower interest rate. This chart shows us that borrower B has a financial advantage with a no closing cost mortgage if the borrower lives in the home or keeps the mortgage for less than 66.83 months, while borrower C has a financial advantage for more than 83 months by financing their closing costs. In the case of refinancing, again, it's important to estimate how long you plan to remain in the home or keep the new mortgage. A no closing cost mortgage will allow a borrower to pay closing costs without an increase in loan amount, directly impacting the equity in the home and the payoff once the home is sold. In an environment where interest rates are falling, a no closing cost loan can also make a lot of sense because a borrower can refinance multiple times without an increase to their loan balance. A borrower may also choose to include prepaids for property taxes and homeowners insurance in a no closing cost mortgage. The lender simply needs to determine the amount of credit needed and set the interest rate at a level sufficient to provide the amount of credit needed. In many cases, a borrower may have saved enough money for down payment, but have not yet saved what's needed for closing costs and prepaids. In this case, a no closing cost mortgage can be a great option, allowing the borrower to purchase the home they want today. If you would like to explore a no closing cost mortgage or question if one is right for you, please reach out to your Prime Lending loan officer for more details.